Welcome to today's Canary report on July 1st, 2026. Markets are in a cautious rotation mode as investors digest a sharp spike in Treasury yields alongside persistent tech sector weakness. We see clear signs of capital moving away from duration-heavy positions toward hard assets and innovation-focused themes despite broad index declines. Let's see what our canaries are telling us about where the money is actually flowing right now. Speculative sentiment remains bifurcated, with innovation-focused leaders like ARKK and MAGs posting strong gains of 1.69% and 2.47% respectively. While SPHB dipped 2.05%, this divergence suggests smart money is selective rather than fleeing the speculative sector entirely. The strength here aligns closely with the SpaceX Nasdaq 100 inclusion news, which continues to fuel momentum in infrastructure and deep tech ETFs, even as broader tech faces valuation compression. The 10-year Treasury yield surged 1.29% to 4.47%, creating immediate pressure on duration-sensitive credit instruments like HYGW and HYG, which drifted lower by 0.1% to 0.49%. This rapid move in sovereign rates indicates a flight toward short-duration liquidity, rather than panic selling of corporate debt. High-yield spreads remain tight for now, but the sharp yield spike confirms that risk tolerance is being recalibrated downward against inflation expectations. Volatility products UVXY, VIXY and VXX all rallied between 0.68% and 1.21%. Signaling active hedging behavior ahead of potential Q3 turbulence. This aligns with Bank of America's warning about a potential three-wave correction, as traders are layering protection into portfolio before earnings season fully ramps up. The VIX itself ticked higher to 1659, confirming that fear is waking up, but not yet reaching crisis levels. The semiconductor sector, SMH, was the standout drainer, dropping a steep 5.56% as chipmakers led the rotation out of megacap growth. However, industrial ETFs IYT and regional banks Canary both gained ground, suggesting that non-technology economic pillars are holding their own despite softer ADP job prints. The data shows resilience in manufacturing and services, while tech hardware faces its periodic valuation reset. Gold, GLD, rose 0.84% against a backdrop of TLT, declining 0.81%, indicating investors prefer physical assets over long-duration treasuries as the inflation hedge of choice right now, while bond and XLP remained flat. This relative outperformance by gold suggests capital is prioritizing purchasing power protection over pure crash hedging. The safety trade has clearly shifted from defensive equity sectors into hard commodities and precious metals. The market is navigating a classic transition phase where yield dynamics are overpowering momentum flows, forcing speculative funds to rotate selectively rather than retreat broadly. Speculators remain engaged in innovation themes, while the real economy shows mixed signals with tech hardware under pressure but industrial services steady. The key takeaway is that duration risk has become the dominant constraint on portfolio construction this week. That's your Canary report for today. Stay vigilant as the Fed response to these yield moves will likely dictate whether we see further rotation or a broader pullback in coming sessions. We'll see you tomorrow with more analysis on how SpaceX inclusion reshapes the tech landscape.